For an investor, the phrase special situation is likely to suggest something that is unique, something that's opportunistic, and most importantly, something that is likely to be exceedingly profitable. But other than expectations, most investors have absolutely no idea what a special situation is. My own interest in understanding more about this subject peaked when I noticed that there are a few schemes that make use of this phrase, and between them they have over 7,000 crores in AUM. That's quite a bit, and so in this video we shall look under the hood and try to get a better hang on what exactly is a special situation. In doing so, we'll also try to present some examples, and if you find this video interesting, then don't forget to share this video with at least 5 special people in your WhatsApp contact list. Let's begin. A special situation in investing is an unusual event related to a stock or any other asset that is seen by investors as a buying opportunity. So we use this word unusual, and that's because the usual way for businesses to make money is through the buying and selling of physical goods and services. The unusual and special part comes in when companies involve themselves in certain financial transactions that are seen to be creating additional value to the shareholders. These financial transactions include things like raising capital, changes in the corporate structure, mergers and acquisitions, reorganization, spin-offs, delisting, buybacks, asset sales, etc. In essence, special situation investing have 3 defining characteristics, which are: 1, these opportunities generally emerge out of corporate actions and hence are not dependent on the company's products or the direction of the stock market. Secondly, the estimated and expected risk one takes in the special situations should be on the lower side. And thirdly, unlike normal investing, a majority of the facts that one needs are already available in a special situation opportunity. This information can come in the form of an announcement by the company to the stock exchange, news releases, company notices, investor presentations, etc. Now, the rest of this video will be about exploring some of these situations and how investors use these opportunities to make a high return at a below average risk. Spin-offs and demergers involve the transfer of some assets and liabilities of a company's business division into a separate entity. As a consequence, the shareholders of the parent company receive shares in this new entity, and is often the case the combined value of the shares, that is, the shares in the parent company plus the spin-off unit, is greater than the earlier situation. This process is often called the unlocking of value and has been done by many prominent business groups such as Reliance Industries, Bajaj Auto, Max India, IIFL, Aditya Birla, the Adani Group, and many others. As an example, let's understand Flipkart. When Walmart acquired a majority stake in Flipkart in 2018, it paid about $16 billion for the company's setup, operations, brand, and assets. Now, one of the companies operating within the Flipkart umbrella was PhonePe, which probably held a very small value in 2018 but is now valued at $5.5 billion. Which means if and when Flipkart spins off PhonePe as a separate unit, the parent company Walmart is likely to make some solid gains from their initial investment. Corporate India sees a number of demergers every year, and while some are good for the shareholders, there have also been many occasions where there has been bad blood between the shareholders and the management. So one has to be careful in understanding how these situations are constructed. If you want to do some digging of your own, then try analyzing some of these potential demergers whose whiff we got from some unconfirmed news reports. There is the Aarti Industries demerger of its pharma business. Then there is Shipping Corporation of India that is spinning off its non-core assets. And of course, there is the much speculation around ITC spinning off ITC Infotech as a separate unit. So try these out and let us know your findings in the comment section of this video. Companies frequently use acquisitions as a long-term strategy for growing a business. This M&A activity is often the hallmark of a matured player in a matured industry that is looking for new growth. But lately, we have also seen acquisitions being used as an incubation center or to expand the company's offerings. Baiju's recent buying spree would be a good example of that. On a special situation front, these M&A deals can lead to some healthy and quick gains for investors who recognize these opportunities. For instance, let's go back a couple of decades when Ponds India was merged with Hindustan Lever Limited. According to the merger scheme, 3 shares of HLL were offered for every 4 shares of Ponds India. Now, 1 share of Ponds was being quoted at 1,250 rupees, give or take a few rupees. So 4 shares of Ponds India came to 5,000 rupees. And at the same time, 1 share of HLL was at 1,960 rupees, which effectively means that a smart investor could simply buy 4 shares of Ponds at 5,000 rupees and then convert them into 3 shares of HLL, which will be worth 5,880 rupees, giving this investor a gain of 880 rupees on an investment of 5,000 in just over 3 months of this merger process. On an annualized basis, the investor would have made a 70% return. Now, it's often observed that price discrepancies do prop up during M&A activity. So it comes up, it fades out from time to time, and that's largely due to the complexity of the process. For instance, it was in 2019 that Tata Steel won the bid to acquire the then insolvent Bhushan Steel Limited. Since then, Bhushan Steel has been renamed as Tata Steel BSL Limited and has been awaiting a merger for over 2 years now. Anyways, per the merger ratio, 15 shares of Tata Steel BSL would get you 1 share of Tata Steel. And per this logic, it is expected that if Tata Steel was trading at say 750 rupees, Tata Steel BSL would trade at 1/15th of that price, that is at 50 rupees, and so on. For a considerable period of time, that was truly the case, and the prices of Tata Steel and Tata Steel BSL moved in a tightly correlated manner. However, something has happened in the last 4 months, and this delicate ratio of 1:15 has been significantly breached. We won't go into what happened and why it happened, but the point is this. There is a mispricing that has occurred, which then leads to a special situation for a limited time period, which then allows an opportunistic investor to use long or short strategies to make some quick money at very low risk. In its simplest construct, a closed-ended mutual fund scheme can be redeemed with the fund house only after its maturity, which typically ranges from 3 to 7 years. However, to provide an exit route to these investors, the SEBI does allow an investor to sell units in a closed-ended scheme through the NSE or the BSE's mutual fund platform. Now, since the sellers of these units are a bit desperate for liquidity, several closed-ended funds trade at a discount to their NAVs, which often ranges from 5 to 15%. This percentage is pretty significant because higher the discount one can receive when buying these units, the higher will be the investor's overall returns at the time of the fund's maturity. Of course, investors need to do their math before effecting such a transaction, which includes a number of factors such as an understanding of the upside, the time to maturity of the fund, the composition of the fund itself, the taxation, and one has to also account for the fact that the traded volumes would be a little thin, as not many people are aware that closed-ended funds can be traded in the stock exchanges. But having said this, this too qualifies as a special situation that allows investors to make a little more money while taking a little less risk. A stock warrant or an equity warrant is an instrument that is issued by a company and gives the holder of that warrant the right to buy shares in the company at a predetermined price and within a stipulated time frame. Now, the special situation we are looking at is where it is much more profitable to buy the warrants of a company rather than buying the underlying shares. Let's understand this with an example. In August of 2009, HDFC Limited issued warrants at 275 rupees each with a conversion price of 3,000 rupees. The conversion option on these warrants could be exercised within 3 years from the date of allotment, that is on or before 24th of August 2012. Now, the face value of an HDFC share at the time of allotment, that is in August of 2009, was 10 rupees a share. Subsequently, the company did a 1:5 split, which means the issue and the conversion price of the warrants was now revised to 1/5, that is to 55 rupees and 600 rupees respectively. Now let's fast forward 3 years and examine the situation on 23rd of August 2012, exactly 1 day before the deadline. What we find on the 23rd of August is that the price of one HDFC share is somewhere around 720 rupees, which effectively means that the warrant holder, upon exercising the conversion option, would make a net total of 120 rupees after paying the conversion price of 600 rupees. And since the warrants were acquired at 55 rupees, that comes to a profit of 118% or roughly 29.7% on an annualized basis, which is pretty good at a time when the Nifty grew by just 4.8%. In fact, in this illustration, we have waited for the entire 3-year period, but most smart investors would not have done that and might have exercised the option to convert in November of 2010 itself, when the stock crossed 730 rupees. That would have given the warrant holder an annualized return of 85%. So for someone who understands the math of this all, warrants can be an excellent way to make quick profits at minimal risk. Now, if you're wondering how can one participate in this arbitrage opportunity, you will be pleased to know that warrants are transferable and can be purchased from the secondary market through your trading broker. Many companies buy and sell business divisions from time to time as part of their operational restructuring process. The effect of selling a division is that the offloading company often receives a big pile of cash, which it can then partially or fully distribute to the shareholders as a special dividend. Let's understand this in light of what happened with Majesco Limited in 2020. Now, traditionally, Majesco Limited would pay a dividend in the range of 1 or 2 rupees to its shareholders. This was the case for many years, but then in December of 2020, the company announced a special dividend of 974 rupees per share, which makes it one of the biggest dividend jumps that corporate India has seen in recent times. You see, what happened here is that Majesco had sold its US business to a private equity firm, which subsequently led to a cash accumulation of over 1,000 rupees per share in its books. And with the company having no avenue to deploy this money, they thought it would be prudent to just give it back to the shareholders as a special dividend. Now, we won't go into the complications of tax on dividends, etc. That's not the point here. But what's important to note is the entire timing of events, which is a crucial component of special situation investing. Like in this case, the first time the announcement was made that Majesco is selling its US business was in July of 2020. Now, one of the major risks in any special situation, especially this type of news-based extrapolation, is that a lot can happen between the first announcement and the assumed endgame. For instance, there's a chance that the buyer might pull out at the last minute, some regulatory hurdles might have come up, the Majesco management might have decided to use the money for buying something else, and so on. I mean, a lot of other scenarios could have happened, and that's why it's important for a special situation investor to build out all the possible scenarios, understand the payout in each case, and most importantly, the investor needs to continue collecting evidence to have a better perspective of what is possible, what is plausible, and what is truly probable. To an everyday investor, a special situation might seem like a fairy tale with a happily ever after ending. But in reality, these investments are fraught with a lot of uncertainty, and therefore it is often suggested that exposure in these opportunities should be limited to a small part of your portfolio. However, if this video has ignited your quest for learning more on this subject, then do pick a copy of the book Investor's Guide to Special Situations in the Stock Market by Maurice Schiller, which is probably the most popular book on special situations. And if you like podcasts, then do listen in to an episode where Joel Greenblatt discusses relative value investing with Bloomberg's Barry Rizalt. Now, before we end this presentation, here's a little homework for you. We mentioned earlier that there are 3 schemes which are labeled or marketed as special situation funds. The Aditya Birla Sun Life Special Opportunities Fund, the Axis Special Situations Fund, and the ICICI Prudential India Opportunities Fund. The next time you're on the ETMONEY app, do go through the list of holdings in each of these schemes and try to understand for yourself if the invested companies do have any special situation opportunity supporting them. And if you find any, then do share your findings in the comments box of this video for everyone's benefit. And with this, we come to the end of this presentation. If you enjoyed the content and examples, then do consider subscribing, liking, and sharing this video with others in your family and your friend circle. Thank you for your time, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.